How is capital gain calculated on a home sale? Have you ever wondered how the profit from selling your home is calculated? Understanding capital gains on a home sale is essential for effective tax planning. Let's break it down step by step. First, capital gain is the difference between what you sell your home for and your adjusted cost basis in the property. The adjusted cost basis starts with the original purchase price of your home. From there, you add any significant improvements you made. However, if you claim depreciation because you use the home for rental or business purposes, you need to subtract that amount. Next, selling expenses come into play. These include real estate commissions, legal fees, and closing costs. You subtract these expenses from the sale price to determine your net proceeds from the sale. Now let's look at the formula for calculating capital gain. You take the selling price, subtract the adjusted cost basis, and then subtract the selling expenses. This gives you your capital gain. For example, let's say you bought a home for $300,000. If you made $50,000 in improvements and sold it for $600,000, your adjusted basis would be $350,000. After paying $40,000 in selling costs, your capital gain would be $210,000. From a tax perspective, the Internal Revenue Service allows homeowners to exclude up to $250,000 of capital gains from taxation if you are single. If you are married and filing jointly, the exclusion increases to $500,000. To qualify for this exclusion, you must have owned and used the home as your primary residence for at least 2 out of the last 5 years before the sale. Additionally, you cannot have claimed this exclusion on another home sale within the previous 2 years. If your capital gain exceeds these exclusion limits, the amount above the exclusion will be subject to capital gains tax. The tax rate you pay depends on how long you own the home. If you owned it for more than 1 year, the gain is usually taxed at long-term capital gains rates, which are generally lower than ordinary income tax rates. If you own the home for 1 year or less, the gains are taxed at ordinary income tax rates. To summarize, calculating capital gain on a home sale involves determining your adjusted cost basis, subtracting selling expenses from the sale price, and applying the home sale exclusion if you qualify. This process is a key part of tax planning education and general tax planning strategies, helping you minimize your taxable gain and understand your financial situation better.